Welcome to the deep dive. Back in January, gold was frankly untouchable.
Oh, totally.
It was cruising at an all-time high of $5,600 an ounce. But today we were looking at a 6-week low and a violent flash crash.
Yeah, it's brutal.
It just smashed straight through that psychological $5,000 floor. Right now, it's trading in the wreckage somewhere between $4,650 and $4,710. So we are unpacking the March 19, 2026 gold market update to figure out what happened.
Right, exactly.
Okay, let's unpack this. How does a historically stable asset, lose so much value so incredibly fast?
Well, you really have to look at the macroeconomic gravity that's pulling on the market right now, specifically from the Federal Reserve.
Correct interest rates, right.
Exactly. They just committed to a hawkish hold, locking rates at 3.75%. And that decision, it completely evaporated the market's expectation for any 2026 rate cuts.
Which fundamentally changes the calculus for holding gold.
Yeah.
Think about holding gold like stashing cash in a mattress.
That is a great way to look at it.
Right, if I hold gold, it just sits there. But with rates locked high, the U.S. dollar and Treasury yields act like this massive industrial vacuum cleaner.
Sucking all the liquidity out of the broader market, yeah.
Exactly. If you are a major fund, why sit on a non-yielding asset when a high-yield Treasury literally pays you a premium just to hold it?
Right, and that vacuum cleaner effect is driven entirely by real yields. What's fascinating here is how the market is treating inflation data right now.
How so?
Well, we are seeing producer price index inflation coming in red hot. Plus, Brent crude oil is pushing, $110 a barrel.
Oh, wow, yeah. Stagnant growth plus hot energy prices.
Yeah.
That is textbook stagflation.
It is.
But wait, historically, a stagflation scare is the ultimate catalyst for a gold rush, isn't it?
Normally, yes, but the mechanics have totally flipped. Instead of viewing gold as the inflation shield, modern capital markets are looking at that $110 oil as a guarantee.
A guarantee of what?
That the Fed won't cut rates. Exactly. A guarantee that the Fed will be forced to keep rates restrictive for the long haul. So rather than fleeing into gold, institutional money is fleeing into the U.S. dollar.
Making the dollar the definitive high-yield safe room.
Yeah, which puts crushing downward pressure on commodities across the board.
Okay, so those macro pressures force gold right to the edge of the cliff. But I have to push back a bit on the actual crash itself.
Sure.
You see the financial press hyperventilating about gold dropping below $5,000. But why does crossing a round number on a screen trigger such a violent mechanical avalanche?
Because $5,000 isn't just a psychological milestone. It's where massive options barriers and liquidity pools were concentrated.
Oh, I see. So it's structural.
Totally structural. When the price fell through that floor, it triggered a massive wave of stop-loss orders, a cascading liquidation event.
Because the algorithms don't care about market history.
Right. The algorithms managing institutional risk, they are programmed to dump exposure the second those technical floors break.
And that algorithmic dumping drags down the entire precious metals sector. Looking at the collateral damage, silver has tanked roughly 11% down to $69.
Ouch.
Yeah, and platinum has bled out to around $1,936.
The selling pressure essentially feeds itself at that point. But we connect this to the bigger picture. The absolute critical metric you need to watch right now is $4,200.
Okay, wait. Which is the 200-day exponential moving average? Explain why that specific metric matters so much to these algorithms.
Well, the 200-day EMA calculates the average price over the last 200 days, but it gives heavier mathematical weight to the most recent trading sessions.
Right, so it reacts faster.
Exactly. For massive institutional trend-following funds, this line acts like a binary switch. If the price stays above $4,200, their models still classify gold as a bull market and they hold.
And if it breaks?
If it breaks below that line, their mandates often force them to flip short. It is the literal line in the sand.
Wow. Given how close we are to that technical bleed out, the long-term forecasts from major institutions are, frankly, wild.
Oh, they are all over the place.
Like Goldman Sachs is completely ignoring the current crash and targeting $6,000 for 2026.
Yeah, because they argue that sovereign central banks are systematically buying gold to de-dollarize their reserves.
Right, which creates a permanent demand floor regardless of what the Fed does. Then you have JP Morgan plotting a more moderate recovery to $5,055 by the fourth quarter.
And then you have contrarians like Robert Kiyosaki.
Oh boy, yeah. He predicts this will ultimately end in a staggering $35,000 an ounce.
Right, because he views the current high interest rate environment not as a sign of economic strength, but as a pinpricking a massive sovereign debt bubble.
So in his view, this flash crash is just a temporary liquidity scramble.
Exactly. A scramble before a total fiat debasement forces everyone back into hard assets.
So what does this all mean? For you, listening to this play out, it really forces a total reevaluation of how capital moves today.
It absolutely does.
We are watching an asset, literally renowned for being an inflation hedge, get aggressively dumped for the U.S. dollar right in the middle of $110 a barrel oil and massive stagflation fears.
It's historically unprecedented.
It is, and it leaves you with a deeply provocative question to mull over. If the old rules don't apply, what actually defines a safe haven asset in 2026?